Welcome to the daily update. This is being prepared Wednesday, October 5th, where we'll look at the action in the market today and then see how things look for Thursday, October 6th. And the kind of hope that I'd had if you watched yesterday's video was that we might have some kind of a pullback, but not very much. Well, by the time we closed, that ended up being true. At the same time, we saw the prices really decline right after the open, and it looked like things were going to get kind of nasty. But then the market was able to find support, bounce up off of that, and made a pretty impressive recovery going into the latter part of the day. So that could be seen as positive, even though we closed down on the day. So let's go back and talk about what happened. Right at the open, we gapped lower to R1, excuse me, to S1 at 37.48. And then selling continued, but we didn't get all the way down to S2. With the big movements up that we saw on Monday and Tuesday, the 2.5% to 2% moves, that means our pivot levels are pretty far apart because they're always calculated on the previous day. So they weren't as much into play because the movement in Wednesday's session wasn't as dramatic as what we saw. But we never did get down to S2. If we had, that was at 37.04, but we were able to stay above that. As the day went on, prices rebounded, got back up to the daily pivot at 37.70, continued to climb, and even went positive briefly. That was seen as a real recovery. Going into the close, we did close off of the high, and we were slightly negative overall. We were down 0.2% on above average volume, right at about average. The average line that I use in volume for today, well, they're just about on top of each other, but volume's just a little bit more. The technicals still continue to be negative, but we're trying to bounce from this oversold condition. We still have a few of our indicators that are looking overbought. That's more in the short term because they gyrate around a lot more. Excuse me for having to clear my voice. I don't have to do that until I start recording. It's just amazing how that works. The markets are still really fixated on inflation and interest rates. And yes, this scenario is coming out again that maybe inflation is going to start coming down and that the Fed can ease off on raising interest rates, even though there's been nothing that I've seen coming out of the Fed to show any kind of a pivot. The market keeps baking this in to try to give it some support, only to have it dashed at some point. But we're not getting any confirmation of that. And this has happened. This would be the fifth time that I can recall in 2022 that the market is developing a scenario that seems to really oppose what the Fed has stated repeatedly what they're going to do. Of course, we still have geopolitical concerns, the situation between Russia, Ukraine, and then just Russia with some of the rumblings going on there. Things appear to be calming down for the time being in the UK, and then any Fed speak that we might be getting. So what are some comments? We did have that impressive rebound after we opened down pretty strong. The S&P at one point was down 1.8% before it started to bounce back up. So that's pretty impressive overall. And then this is the scenario, and I made up these words myself. The inflation has topped, so will the Fed scenario continues. I'm seeing that in things that I'm reading. I'm hearing that people coming back with that same scenario again, even though there's really no evidence for that from the Fed yet. Oil is starting to go back up, and this is kind of poor timing right before the election. OPEC has come out and said that they're going to start limiting their supply in November. Now, a few years ago, OPEC really wasn't all that relevant, but with everything shifting and changing right now, the fact that they're going to be limiting the supply of oil that they do put out into the market, that is having a tendency to push oil back up. We still have the same yield curves that are inverted, the 30 to the 5, the 10 to the 2, and the 10 to the 5. That hasn't changed. Sentiment is still fearful. We're not extreme fearful at this point, The strong upward moves on Monday and Tuesday really helped some people feel a little bit better about things. And then if we do resume this upward movement, if we really get a bounce that turns into a bona fide change of trend, and I did make it right this time, there's this thing called FOMO, the fear of missing out. And that's what a lot of folks tend to do because they can't watch the market all the time. They base a lot of their decisions on what happened today, and then they react to it the next day. And that might be the exact wrong time to do it. Plus, a lot of people don't really use a systematic approach to the markets. They go based on how they feel about things, and that can be very dangerous when it comes to the stock market. Might work in other areas of life, but it just doesn't work in the long term or even in the short term when it comes to the financial markets. We did get the weekly MBA mortgage application index, and look at how this has fallen. Last week, it was down 0.37%. This week, the reading is that we're down 14.2%. So this is starting to really impact the housing market because folks aren't applying for mortgages. The ADP employment change, it came in greater than what was expected at 208,000. They expected it to be at 198,000. Now, sometimes this number is really different than what we're going to see on Friday with the employment situation report. So they use different methodologies for how they calculate all of this, and the numbers can be way off from each other. The ADB one is becoming a little more relevant, but still, folks tend to look at the big number that comes out on Friday. The U.S. trade deficit also narrowed to 67.4 billion. That's just a tiny bit less than what they expected at 67.9, and it's coming down where it had been at 70.5 billion. That's just, there's less trade going on back and forth right now. The Ihs Market Services Pmi, it came in at 49.3. The last time we had this report, it was at 49.2. The fact that we're under 50 shows that we're in a slight contraction with the economy, but this isn't a real heavy-duty report. This next one is the non-manufacturing ISM, that index. It fell 56.7, still above 50. And this was actually stronger than expected. They expected it to come down to 56. The last time we got this reading was 56.9. That may have, even though it came out 30 minutes after the market opened, a lot of the reports that we get come out at about 8:30 Eastern time. This one comes out at 10 o'clock Eastern time. And that's when we saw a real increase in the selling at that point. But then, as I said, the market found a bottom and then was able to rebound up out of that. Our trend is still negative, but it's weakening. And we're getting to the point where the ADX is just about ready to cross below the moving average, especially if we see more upside in Thursday's session. We're still above 20, though. I'm keeping our bias at mixed right now. Yeah, it wasn't a big down day, and I did have it as positive, but we're at kind of a tipping point right now. We could go down, we could go up. There's a lot of evidence on both sides to suggest that one or the other could happen. So as we're waiting for things to play out a little bit, I switched it back to mixed, and I've also kept our momentum at mixed as well. Let's go back and look at the day's session. Fear is right now at 31. So we are in the fear camp, but we're not as extreme as we had been just a few days ago. Here's some Isabel Net charts. This is just showing, this is a Morgan Stanley chart where the blue line here, this is the US nominal GDP. Nominal means they're not taking into account inflation. This is just the number that comes out, and it's not adjusted in any way for inflation. And then the 12-month forward EPS, that continues to rise. So what I'm getting from this chart is that as GDP continues to go up, according to this, that the earnings per share looking forward is also continuing to climb. So that would be more positive. Now, we've seen a lot of other charts that would completely contradict this chart, but that's what they're showing right here. Also, we have the E-mini futures and their liquidity chart. We're starting to watch that a little more closely. And it says here, the decline in U.S. equity market depth. That means when these lines are going down, this is like a depth chart. It tends to lead to violent market moves. And we've come back up a little bit lately, but we're still continuing to drop down. And the futures markets really help keep the stock market more under control because they're highly leveraged instruments and they're very liquid. People can get in and people can get out really quickly, and that adds more to a healthy market environment. When they stop doing that, or at least don't do it as much as they had been doing that, that can really push prices more extreme in one direction or the other. This is just showing Goldman Sachs forecast for CPI on a year over year basis. They're expecting the headline number. This is the one that everybody reports on, where we hit up here. We have been coming down. It was the same in the last reading, and they expect this to continue to fall. Then when you take out food and energy, they expect inflation to fall on this chart as well. We don't know if this is really what's going to happen. There's a lot of evidence to suggest that we're just getting started with inflation, and that things are not going to start coming back down. They're going to actually go back up. But this is the chart that Goldman Sachs is going with right now. Looking at our right X bear bull ratio, you notice how we really spiked up. And remember, there's a day or two lag here. We spiked up when everything freaked out on Friday. Well, with the real strong day on Monday, a lot of people were getting out of those bullish funds. And this will probably continue to fall because we'll have to get the data for Tuesday. And that was a really strong up day as well. But after getting to an extreme reading, we're now starting to come back down. Can that continue? Here's the sentiment chart, just showing how we've gone down. Again, this doesn't take into account the big days that we had earlier. This is just showing how we were coming down and setting new lows with the S&P. That's the lighter blue line right here. And sentiment is getting pretty extreme negative. Well, we've been seeing that in our other charts and our other measurements as well. This is the S&P average realized volatility by month. This goes back to 1928 and comes up through 2021. I've highlighted October right now, where we can tend to be quite volatile in September, right in here. But now we're coming into October. And so this can really be a pretty volatile month, meaning a lot of upward and downward movement. The average is the dark blue line. The median is the lighter blue line here. So just expect the market to move is pretty much what this chart is saying. This is another chart. The Fed expects to keep policy tight for several years. This kind of flies in the face of that. We're coming down. The Fed's going to turn more kumbaya-ish and start to lower interest rates. Well, they're going to keep going up. They're still estimating the neutral rate at about 2.5%. They're going to get up over 4%, keep it up here for a while, and then slowly start to come down. Now, this could change with any of these geopolitical events, some kind of economic thing happening, something that comes into the economy that hasn't been anticipated could totally blow this forecast out of the water. But a lot of people use this right now to make decisions of where they think things will be going into the future. This is just showing how, even though we're coming down with the non-farm unemployment level, it's been coming down. They drew a line over here to kind of see where we topped out. We're still very far above where we're at. And what I'm getting from this is, even though we're seeing this decline, it still shows that the employment situation is still quite positive overall. And this is giving justification for the Fed to remain more hawkish. Here's a whole crazy chart full of numbers. The one to really focus on right now, this is 2022, and what happened after September got over. So it says, wake me when September ends. The 10 S&P worst starts to a year, and we stopped counting this in September. What happened after that? Well, if you go down here, and this is just average, this doesn't mean this is what's going to happen. This just shows what has happened in the past. The average return has been 4.9% from September. Going forward, the median return was 7.9%, 90% of the time if you look into the next quarter. The next 2 quarters was a better performance, 10.6 and 16.6, 80% of the time. And if you go out 4 quarters, so a year from now, the average return is 17%, 25.5%, 80% of the time. Now, that's fine and dandy, and that may be what happens. But remember, 90%, that means 10% of the time it doesn't happen. 80%, that means 20% of the time that doesn't happen. That's where I tend to come out on this. Okay, it's a nice thing. It's something good to know that maybe we have the odds are in our favor. But at the same time, it means that we can't just take this for granted either. All right, then this is a little more positive too, where the GDP now forecast, it had come down to 0.3, then they raised it to, I think it was 0.5. Now they've gone back up to almost 2.7 for the GDP. So this is just forecasting the GDP is looking better as of right now. And then looking at the euro, and when it's been going all over the place, as the British pound has been doing that, as the dollar's been going up. And it just says here, the euro rates of volatility were actually above what we saw back during the great financial crisis back in 2008, 2009. So I'm not sure what to make of this. We're in really weird times now. A lot of people are trying to make a direct comparison between now and the great financial crisis. In a lot of ways, they're different, and in many other ways, they're the same. So just showing, because that's really all we have to go with is what has already happened, and what might be the probability of what will happen in the future, realizing that it doesn't always play out exactly. All right, let's go back and talk about the session. Growth, even though it was down less than value for the large caps and for the mid caps, but it did go down a little bit more for the small caps. The VIX continues to fall, even though we had a pretty solid downward movement earlier in the day. We came down on the bar, or we went up with the bar, meaning fear was increasing, but we closed right at the bottom of the bar. So the VIX ended up closing down from Tuesday's session. The VIX of the VIX is also showing that fear is coming down because the VIX itself is moving less. The Ulcer Index is declining just a little bit more, showing fear is starting to subside slightly. We're down 21.49% from the all-time high. Here's the mark over here, the red line that I have on the bar. The equity put call ratio, since we were negative earlier in the day and even closed down, that did go up a little bit. Over 5 periods, though, after setting this spike, we are still continuing to fall. These are posted on the YouTube channel. Here are the pivot points for Thursday's session. And here's the daily chart, where we did come down below the pivot, but we were able to close back above the daily pivot. And if you see down here, volume and the blue moving average are just about on top of each other. This is also posted on the YouTube channel in the community tab, just showing the different pivot points that we'll be using for the month of October. And then this is that short-term fib level. We broke above it a little bit as the day went on, but we closed just a little bit under it right now. We might want to count this as continued resistance until we can actually close above that. That would actually take out the resistance. One thing that I didn't mention yesterday is when we had the big up day on Monday and Tuesday, we closed this gap right here, and that could be seen as positive too. When we were coming down, we were gapping lower. Well, now we've been able to close that gap and stay above it currently. We just want to know, is that going to last? Longer term, we're coming back up to what could be some overhead resistance. We have 2 fib levels that are on top of each other right here at about the 38.26 level to 38.20 or so, right about in that level. And then this is still continuing to be positive, but we have to watch out. After bouncing up off of the 200-week moving average, We came just about up to this 38.2% retracement. We didn't quite get there, but this could still be seen as overhead resistance at about 38.18. So we're seeing kind of a convergence of different resistance levels near each other right now. We need some strong volume where we can get above these levels and then end up closing above these levels as well to have this turn more positive. We're coming back up to the midpoint with our trend channel. Looking at the sectors, most of them ended up being down, led by utilities falling, and real estate materials. They were down all over 1%. We had tech, healthcare, and energy. Energy was up over 2%. So it's seeing a bit of a rebound now. Some of that's probably coming out of the OPEC announcement. Our scooter score just shows that the only chart that's really looking good right now is the energy sector chart at 99.3. We have real estate, which is now taking up the rear at 5.2, and communication, which has been in single digits for quite a while now. It's at 6.7, showing how the energy sector has been rebounding. We had gotten below into the 30s, even into the 20s at one part here. But utilities, after really looking good there for a while, they still continue to be negative, as does all the rest of the sectors. And here's just the updated percentage changes. The pink one is the S&P. What have the indexes done since the S&P hit its all-time high way back in January? Technical alerts, some positive, some negative. The S&P had a bullish MACD crossover, and I'll show you the chart of that. That's one of our oscillators. It has turned positive. At first, the NASDAQ went below 11.1, then it went below 11,000. The S&P was able to get back above 3,800. The NASDAQ worked its way back and got above 11.2. And then the dollar, because we saw some dollar strength, that was kind of going with the stock weakness right now. So the dollar regained some of what was lost. But we continue to see, like the healthcare, a BPI crossing above 30, energy, BPI above 30, financial, bullish MACD crossover, as with the industrials. So we're seeing, based on price, we're starting to see some favorable price action with things turning more positive. Our scores, the mid caps still continue to be looking the best at 67.1, followed by the small caps at 56.1, the Dow's in third place at 55.5. The S&P, it was up a little bit, but it's in fourth place right now at 41.5. And the Qs showed some improvement, but they're still not even above 20 yet. Here's our intraday chart where we did gap lower right down to S1. We broke down here. We were able to set some support right at this level. See how we never got down to S2. And then the market just staged a nice little comeback. See, this was the opening amateur hour is what they call it. Once that got all out of the way, then you have the folks that really want to drive the market coming in, doing what they want to do. Got back up to the daily pivot that acted as some resistance for a while. We broke above that. We actually went positive as we were getting closer to the close. We didn't even make it up to R1, but then we did close off of the high. So that's pretty impressive in spite of what has been happening in recent history. Our trend, because we're showing a weakness in the trend, it's not quite dropping below the moving average now, but the red line continues to decrease even though the green line was flat. The Arun, it was also flat. Looking at breadth, actually we were down on the day after having just 3 monster up days recently. So a little bit of weakness based on price and volume. The advanced decline ratio is trying to bounce up after going extreme negative. New highs, new lows are still showing a little bit of an improvement with our 5 period, and our 10 period is now turning back up. The accumulation distribution also showing some improvement where it's crossed above the moving average. Short term, believe it or not, here's a moving average chart. Here's the 20 period, both simple and exponential, moving average charts where we're coming right up to this. And the reason I brought up this chart is this might act as some kind of resistance where it's the red line that's the most important. Most people tend to focus on the simple moving averages, and that's the red one. So if we start to go up a little bit higher, let's see if we can break above that and then close above that. And then there are other moving averages above where we're at right now. We'll do the same thing with those. If we even do that, the Stochc RSI is still extreme positive, where the Williams percent R is still showing some improvement. The force index is still showing some improvement, and it's kind of on the outside of the Kiltner band here. So that's still a little extreme positive or overbought right now. Our Swindler trading oscillator ticked down a little bit based on price, and a little bit was pretty much flat based on volume. This ended up being very helpful to us, so we'll want to keep an eye on this. The McClellan oscillator, after going above zero and turning positive, did decline with the slight decline that we saw. And the improvement that we saw with the 20, 50, and 200, the 20 turned down slightly, where the 50 and the 200 were mostly flat. The Stochc, the short-term stochastics, still looking better, with the intermediate term looking better, and the longer-term stochastic is still trying to turn up from extreme negative. Intermediate term, the Sean trend meter ticked down slightly. The PMO starting to show some improvement. We have not crossed yet. Sometimes the price and volume indicators that we use here, sometimes they will lead the PMO itself, but none of these have crossed, even though they're looking a little better. The PMOs that are rising after going extreme positive did decline a little bit, but they're still extreme positive. The buy signals are improving, and we're turning up with those PMOs that are above zero. Chaikin oscillator continues to advance, and it's above this dash line. That's more positive. Where the Chaikin money flow declined just a little bit, but is still positive overall. Volume dropped off because we dropped right down to the average that we've been seeing lately. The vortex continues to decline with the red line and a little bit of advancing with the green line, but this is still negative overall. The summation index based on price is flattening out and turning up ever so slightly, but we're seeing this start to bounce based on volume. This could be a leading indicator right now. And we kind of got a mix right now with our oscillators. The slope is turning back up. The MACD did have a crossover. We're turning up with the KST and a little bit with the tricks, but they're still negative. Turning up and looking better with the PMO, and we did go positive after yesterday with the TSI, the Trend Strength Index or indicator. Bullish percent index, even with the down day, still showed a little bit of improvement. It'll turn more positive once it gets above this 30 level, but it hasn't done that yet. Ease of movement still continues to show some improvement. Ultimate oscillator crossed above the midpoint. That's more positive. Money flow still going up. The boom indicator starting to come up after giving us an extreme negative reading and showing some improvement with the 200. If we continue to go up, I'm probably going to stop showing this chart. I usually only bring it up when we're giving extreme readings. TTM squeeze still kind of negative, but showing some improvement. Balance of power is also showing improvement, but still below the dashed line. And the CMB, which had a initial and then confirmation signal, it continues to advance. Our different charts still looking better with the Heiken Ashi, still positive because we turned to black with the Kegi. The Renko, though, is still negative. Three-line break also showing some improvement. And we added a new X in here with the point and figure chart, but there's no new signal. So again, we're kind of mixed right now. Some of these are positive, some of these are still negative. The Elder Impulse for the S&P is still positive, as it is for the SPY. We still have the dots below with the SAR. That is positive. We're still in the pale purple land as far as the no-go system is concerned. So it's neutral with a negative slant. Long term, we're still pretty extreme with our 50, 150, and 200, even though we're trying to show some improvement here. but with the down day, we were kind of flat with our longer moving averages. I didn't show this after yesterday, but now we're finally starting to turn up from extreme negative with the rate of change going back 200 periods, which is pretty much matching where the COVID low was. Special K continues to fall. Going to take a while for that to turn. The diamonds continue to be positive, and the Dow is still above this pivot level currently. So the things are holding up fairly well right now. The Qs are also positive, and we're right on this pivot level. We want to watch the NASDAQ and the NASDAQ 100 and growth stocks in general to see if we really start moving up or down for that matter. What is the NASDAQ and the NASDAQ? What are they doing? The VIX with the kind of down day it ticked down a little bit on a closing basis and really didn't move all that much. With the bar chart, here's the NASDAQ. We're just a teeny tiny bit above the current pivot level. Mid caps are still above the pivot level, and the Wilshire is still above the pivot level. So things are still holding up for right now. The dollar, after getting hammered over the last few days, did bounce back up 0.94%. And here's the S&P to the dollar, still having a tendency to go in opposite directions. Gold, after just, this is it, this is the real one right here, baby. Well, it was down 0.55%. And silver, after this is it, baby, we're going to the moon now, it was down 1.91%. Oil is starting to creep back up to 87.76. The correlation between the S&P and oil still have a tendency to go in the same direction. Bonds showing a little bit of weakness with our total bond ETF and a little bit of weakness with our world bond index. And because bonds went down more than stocks, we're seeing this one-to-one relationship starting to get a little bit weaker, but they're still having a tendency to go in the same direction. Our yield curves have not changed. 10 to the 5, 10 to the 2, 30 to the 5. Still watching the 10 to the 3 month. Gets close, but it never seems to really want to go inverted. The tech sector to the 10-year, they're tending to go in opposite directions, but this is starting to move back more towards neutral. Here is with the blue, green, and these are all, because the blue one's the 2-year, we saw a real increase in the longer term maturities where we were flat to slightly higher with the 3-month. Our scenarios, just to give you an update, not a lot of changes, still showing some improvement based on price and volume after giving us an extreme negative reading. Those stocks that are above their 200-day moving average just came down a little bit. The stocks above their 50-period moving average really didn't change all that much for the S&P, the mid caps, or the small caps. The 10-day average of S&P highs, lows, still extreme negative. This is the internal things that we're not seeing happening yet. We want to see a real expansion of new highs if we're going to get set to go higher from here. And this is kind of suggesting that as well. Even though we're seeing an improvement on a broad basis, we're still below this zero line. For this to turn much more positive, now that we went extreme negative, would be nice if this would go above zero. And then the equity put call ratio, looking back 5 periods, after spiking up, it continues to decline. So that still appears to be valid. The small caps held up okay. They were down a little bit more than the S&P, but they're still above the pivot. And this was an inside day where the high and the low did not exceed the high and the low from the previous day. The ratio is still looking okay here. So we want to start to watch this red chart to see if this is really, if this spike up is going to continue to get some more legs behind it, because that might give some support to the S&P 500. The correlation between the S&P and the 10-year, it's turning back up slightly, but they're still having a pretty strong tendency to go in the opposite direction. Our sector rotation it's doing okay, but it's not really giving us the support that we were hoping that it would. The Qs were up a little bit, but they're still below the moving average. where the discretionary is pretty much flat to down, and the large cap growth against large cap value is still under the moving average. And the mid caps are showing a little bit of improvement, but we're still seeing some continued strength in the small caps, which could give some support to the S&P if it can flow through that far. The S&P to the 2-year still having a tendency to go in opposite directions of each other. And the spike, we're coming just down just a little bit. So we don't know if this is going to be a valid spike or not. This is also encouraging. The S&P to the utilities ratio, it's continuing to show the S&P is starting to outperform utilities. As utilities fall, and if the S&P can continue to go up, this might provide more of support for higher prices. The staples ended up being down, and we're really starting to drop here with our staples to S&P ratio. So right now, this looks like it could be a valid spike, but we're just about at the same levels that we were at before. Now, what we need to see is follow through price movement going up from here. And then the scenario that I brought out in yesterday's video, I don't know if it's going to happen. One part looks like it's falling down, other part looks like it's holding up. But we might have a short-term pullback, which we did. It would have been nice if we actually were down a little bit more than 0.2%. But that's what I was seeing first, because we had gotten up pretty far, pretty fast, have a slight pullback, and then the confirmation. Well, the mass index, it's starting to roll over, whether we're having a slight down day or an up day. So this may end up not being valid. My hope was that we could get above this blue line and then drop, but at this particular point, it doesn't look like that's happening. But our Copic curve, it's just getting ready to cross. So, and we went pretty far extreme with the Copic curve. So this might end up being a signal. And since we've been going up, as this has been turning up, this could be a positive signal. But there have been times when this has given us really nice signals, and other times when it's like, what was this thing thinking? No indicator works all the time, including this one. So what's our outlook for Thursday? We're negative technically still, but we're showing some improvement. We still have some oversold indicators and even a few that are overbought. Can the rebound resume? That's what or is the decline going to resume? Or are we going to chop sideways for a while? We have really the only thing coming out on Thursday is jobless claims, and they come out every week. And then the whole list of geopolitical events. But the real fixation right now is inflation and interest rates, as it has been. If we get any kind of Fed speak, that the market's really running with this scenario again. And if one of these FOMC members, especially Chair Powell, does an interview or gives a speech and says, hey, the market's crazy, they're going for this thing again, that could really have a negative influence on things. So we just want to be aware of that. So our scenarios, we're still negative overall, but it's hard to go with that because we're trying to bounce from being oversold. We do have a few overbought indicators right now, but our technical picture is improving. We can't really go up yet because we have not switched over to full-blown positive. We are showing some improvement, but we need to see more follow-through price movement to the upside for that to continue. Can we get above that 20-period moving average? And then can we get above the 50? And then the 100, then the 200? That's really going to help. But we have a lot of overhead resistance too that we have to try to battle with. And sideways, well, if we do drop below the moving average, those of you that use the ADX a little more aggressively, you might switch over to neutral, and I'll probably change the color if that happens. But if you also want it to drop below 20, you're more conservative with that indicator, you're probably going to wait. So our conclusion, the S&P, no, what's the S&P 600? That's small caps. Where did I do that there? If that was there before, I didn't realize it, but it's the S&P 500. We're rebounding from being oversold, and we are improving if prices advance. We have to see follow through price. We can't try to pick a bottom here. We're just going to end up with stinky fingers if we're wrong, which the market has been wrong many, many times here. We need to see some confirmation. That's where I come out with it. Short term, negative, but bouncing. We have some oversold and some overbought. Intermediate term, we're trying to show some improvement there. And long term, we're bouncing up from that. And the only one that I said was oversold was the 200-day rate of change. And that's starting to come back up. But if we see more weakness, that's going to go right back down. So thank you. I hope this was helpful to you. I hope you have a really good day. Go Seattle Mariners as they get ready to go to Toronto for a 3-game possible, 3-game series. It's a best of 3 series in that. And I will look to prepare a video. One thing I do want to mention, and I'll mention it in tomorrow's video, this coming weekend, I'm attending a stockcharts.com conference. It's online, but because I'm in a very different geographical place, I have to be up all night while that conference is going on. And that's really going to mess me up a little bit. So my posting schedule over the weekend is probably going to be different than it has been. So just be patient with me on that. I'll get things done and prepared just as soon as I can.